Term 106. Government bonds. Government bonds, also known as sovereign bonds, are debt instruments issued by a national government to raise money for various purposes, such as funding public projects, social programs, or managing national debt. When you invest in a government bond, you are essentially loaning money to the government for a set period of time, typically ranging from a few years to 30 years or more. Government bonds can be a valuable asset class for investors seeking stability and income. However, it's important to understand the risks and consider your investment goals and risk tolerance before investing. Term 107. Treasuries or Treasury Securities. Treasuries, also formerly known as Treasury Securities, are debt instruments issued by the U.S. Department of the Treasury. They are essentially U.S. government bonds that represent the U.S. government borrowing money from investors. These borrowings help finance various government functions and projects. Types of treasuries: plus Treasury bills, T-bills, plus Treasury notes, T-notes, plus Treasury bonds, T-bonds. Term 108. Treasury bills, T-bills. Treasury bills, T-bills, are short-term debt instruments with maturities ranging from a few days up to 1 year. They are generally considered the safest type of treasury because of their short maturities and are often used as a cash-equivalent investment. T-bills are sold at a discount and the investor earns the difference between the purchase price and the face value at maturity. Term 109. Treasury notes, T-notes. Treasury notes, T-notes, are medium-term treasuries with maturities ranging from 2 to 10 years. They offer a fixed interest rate, coupon, paid semi-annually, in addition to getting the principal back at maturity. T-notes can be a good option for investors seeking a balance between risk and return, with slightly higher yields than T-bills but with some interest rate risk. Term 110. Treasury bonds, T-bonds. Treasury bonds, T-bonds, are long-term treasuries with maturities of 20 or 30 years. They typically offer the highest fixed interest rate among treasuries, but also come with the most interest rate risk due to their longer duration. T-bonds can be suitable for investors with a long-term investment horizon seeking steady income and capital preservation. Term 111. Sovereign debt. Sovereign debt, also sometimes referred to as public debt or national debt, is the financial liabilities of a national government. In simpler terms, it's the money a country owes to lenders. In conclusion, sovereign debt is a complex issue with both potential benefits and risks. Responsible management of sovereign debt is essential for maintaining a healthy and stable economy. Term 112. IOUs. IOU. An IOU, standing for IOU, is a simple form of informal debt acknowledgement. It's not a legally binding document like a contract, but it serves as a written record that one person, the debtor, owes money or something else of value to another person, the creditor. IOUs can be a helpful tool for acknowledging small debts between people who trust each other. However, due to their informal nature, they shouldn't be relied upon for significant loans or complex agreements. Term 113. MBS mortgage-backed securities. Mortgage-backed securities, MBS, are like bundles of home loans sold as investments. By pooling many loans together, MBS provide liquidity for banks and offer investors a chance to earn returns. There are different types of MBS with varying risks and returns. The 2008 crisis highlighted the risks of MBS, and regulations have been tightened since then. MBS remain important in the housing market, but with a focus on responsible lending and risk management. Term 114. FHA Kuk Kwan Li Nao Lin Bang. The Federal Housing Administration, FHA, is a U.S. government agency that helps promote homeownership by providing mortgage insurance to lenders. Essentially, they don't directly lend money to borrowers, but instead 1. Insure loans. The FHA insures a portion of the loan for approved lenders, protecting them from losses if a borrower defaults, fails to repay. This allows lenders to offer more FHA-insured mortgages with less strict requirements compared to conventional loans. 2. Increase affordability. By reducing risk for lenders, FHA helps make homeownership more accessible for people with lower down payments or moderate credit scores. 3. Stabilize the market. FHA plays a role in stabilizing the housing market by encouraging lending activity. Term 115. VA Veterans Administration. The Veterans Administration, VA, is a cabinet-level department of the United States federal government created to provide benefits and services to veterans and their dependents. Established in 1930, it's the second-largest federal department after the Department of Defense. Some key areas where the VA assists veterans. 1. Health care. VA medical centers and clinics, priority care. 2. Education and training. GI Bill benefits, transitioning to civilian life. 3. Home loans. VA home loan guarantee. 4. Disability compensation, financial assistance, vocational rehabilitation. 5. Other services, life insurance, burial benefits, mental health support. Overall, the Veterans Administration plays a vital role in supporting veterans and their families by providing a wide range of benefits and services. These programs help veterans with healthcare, education, housing, disability compensation, and other needs as they transition to civilian life and beyond.